So for the house hackers, let's go into maybe some of the other things that they should be looking into or consulting with someone like yourself about as they enter potentially house hacking, or maybe they already are.
Yeah, sure. So I guess sticking on the passive losses, in order to supercharge these passive losses, I mean, a lot of times when you're buying real estate for the first time, you're going to be making repairs, replacing appliances, whatever it is. Those bigger expensed items, those need to be capitalized. You can't just expense those high priced items in the first year of buying it. But a little trick, I mean, there is bonus depreciation now, which is being phased out. So I'm not going to get into that. But thing that I advise a lot of my clients on, especially like the earlier on real estate investors, is there's what's called de minimis safe harbor election. And so what this is basically, if you get an invoice for $2,500, it doesn't matter what it's for, you can write it off. So it's just a safe harbor election that you have to elect on your tax return, and you can write these things off. They really won't be scrutinized too much by the IRS. So for example, I replaced the flooring in my house. It was $2,300 for the labor, and then $2,200 for the materials. It was pretty close to the $4,500 mark. So I got that invoice and I was like, hey, can I split this up? Can I pay maybe for the materials up front, and then I'll pay the labor once you guys are done with it? And they were fine with it. So what this is allowing me to do is I'm taking a $4,500 loss this year on this flooring, whereas any other time, like if it didn't apply because it was over that $4,500 check mark, I would only be taking a $900 loss or expense deduction on my taxes. So what that ends up looking like is $1,200 back in a refund instead of $250 back in a refund. So this is something, bonus depreciation, these safe harbor elections, just a little bit of planning, a little critiquing, just playing it smart. You can really start to supercharge these losses when you can actually take them to offset your active income. Just different advisory stuff like that. CPA can kind of help you out with just different things to plan for. I guess there is some intricacies with house hacking that can get pretty confusing when it comes to taking deductions. If it's in a unit you don't live in, 100% deductible. If it's in your unit, you can't deduct it. If it's the roof, you have to apply a percentage to it. But then you can take that percentage, you could take those expenses in your unit that you couldn't deduct this year, and then when you actually place it in service, start to reap those benefits. A lot of that stuff just needs to be planned out to make sure you're not just suspending these losses or these deductions, because they're extremely powerful. So if you're diligent, you have an advisor that can kind of help you set up and plan for this stuff, you'll save a lot in taxes and keep you compliant. House hacks, whether it's multifamily, single family, there's personal use limitations, there's mixed use properties, it gets kind of confusing. So to be a beginner and DIY that is probably a pretty heavy lift. So I know I just keep rambling on.
I love it. So what you said about the percentages, like if I live in a 4-unit and I fix the roof, basically you can deduct 75% of that because I'm living in one of the 4 units, or is that going to be based off square footage?
Correct. So you'll probably, unless you're using some of these safe harbors, you'll have to capitalize it. And then, so the first year you can take that 75% of that deduction, but then you can ramp up the deduction later on because you want to accurately deduct different pieces of property. Once you move out, then you can speed up those deductions. If you buy a house and you start depreciating it incorrectly, and then 5 years down the line, you hire a CPA, they're going to have to retroactively go back, correct those mistakes, look at your roof, see that it's all out of whack, correct those mistakes. Like it can then just end up costing you more money in the long run if you screw some of these things up and have someone go back and retroactively correct.
Absolutely. Yeah, I tried to do TurboTax my first year of house hacking, and I was just like, I'm calling somebody right now. I had to go find someone because I just didn't want to deal with figuring out how I'm going to put everything into there. And I don't even think like TurboTax supported a primary residence that you're renting out. And it was just really confusing for me.
And it's just the nature of the type of people we are and the type of people that listen to this podcast. We're DIYers. We're trying to make money. I'm not a general contractor. I figured out plumbing, electric. We always want to do it ourselves, but I don't know, getting into fits with the IRS, and not only that, but you just miss out on so many tax saving things early on too that you can take advantage. I think once you get your first rental, if it's a primary residence, don't worry about it if you're not renting it out. But the people we're talking to who are going to be investing in real estate and house hacking, I think once you get your first property, it's about time to call a CPA.